Hey everyone, hopefully having a good day. My name's Andy. My channel's Finding Value. I was reading through some questions on the Finding Value website that people had emailed me or sent me. A lot of it deals with setting up a portfolio. And again, I'm not a portfolio manager. I don't have the license to give advice or anything like that. It's just my opinion. But some of the questions, I can give my opinion on it. People were asking me, um, basically, some people are very heavily weighted towards one sector versus maybe other sectors. Other questions were on the lines of if I have, you know, X amount of money um, in the commodity markets, is that enough money? What should I be in? Those types of questions. My Here's my opinion and what I've done. Doesn't mean what I've done is necessarily right, and it may not fit everybody. I have a large chunk of money. It's approximately 30% of my entire net worth allocated to physical precious metals. Why do I do that? Because it's the least risk asset of any asset in the world. And if your metals, the physical precious metals, if they're the cheapest they've ever been in relationship to other assets, you can buy these very low risk metals. At least historically, they've been incredibly low risk, and you can gain in them. So think of it as this. Let's say gold doubles and silver were to double or platinum were to double, the physical metals themselves. If I have an allocation of 30 something percent to it, like 30%, and I'm not advocating that people have a 30%, I'm probably way out there in terms of my allocation into physical precious metals. But why is my physical allocation so high? Because if I can't, if the metals beat the stock market, if they've been beating the stock market since the year 2000, and the stock market's been in this gigantic bubble, and it's the least risk asset, well, why wouldn't I go into it? Tell me good reasons why I shouldn't. Because it doesn't pay a yield. Doesn't matter if it's beating it on a performance perspective. They're very hard to tax. You know, they can't come to your house and start shaving off pieces of metal. They don't know you own it. It's another reason why I like it. So if you can't beat the least risk asset in the world, why not just buy it? That's my take on it. And that's why I own, like 30% of my entire net worth in physical precious metals. And that if that's the least risk way, and if I think we're going into a commodity bull market, the least risk way to play it is to get the physical metals. And I am pretty sure if gold goes up, that the physical metal itself will go up with gold. It's a direct correlation between the price of the metal and the metal going up and me owning that metal. It gets a lot. I haven't had as much success with the mining companies historically. Will the success, will this time be a little bit different? It could be because the ratios are far lower. So I do have allocations to the mining companies through mutual funds. I also have royalty companies. I like royalty companies. I just think the business model is better. Yeah, you're going to be paying a little bit more of a premium. I just want a leveraged move to the physical metals. That's all I want. It doesn't have to be the world's largest leverage move. I just want a leveraged move to it. So that's why I own royalty companies. And those are cash cows. I consider them cash cows. So I've developed a portfolio, and I've got diversified mining companies that are cash cows. And I think those are good exposure to a commodity bull market because they're diversified. It's a bunch of metals that they have. They're mining it out of the ground. You're getting paid fat dividends. And that's my exposure on that side. These small little gold and silver companies, they might go mooning at some point. And I do have some exposure to it, just not a lot. But I do have some. So that's my exposure there. I've spread across a whole bunch of different sectors. I have oil and natural gas. I have uranium, shipping, some precious metals, fertilizers, there's a whole bunch that I have. I grab the ones that I think are the best looking from a chart perspective, and also the fundamentals look good. I'm spread across what I consider to be cash cows. Cash cows are companies that can increase when the commodity starts coming back or their service starts coming back. They have historically been cash cows. So historically, they've been a cash cow. They will most likely be a cash cow this cycle, and they're going to be bringing in cash, paying out dividends, and moving along with the markets for sure because they have existing infrastructure in place. So I have a lot of exposure, and the majority of my money is in, quote, cash cow companies. The other companies are developers, and developers don't have infrastructure in place. They have a mine that they are developing. They may have some infrastructure, but they don't have the infrastructure to actually be mining. So those I consider to be a lot more risky. Sometimes when they go to implement projects, the countries and the people in that country change their mind. Sometimes they nationalize things. It's just a lot more risk. So I allocate less money to it, even though the possibility of them going to the moon is there. But I have money allocated towards it. It's my portfolio works together. It's I'm not I don't choose one or the other. I have a strategy to incorporate all of it and to allocate money to less risky things. And then if the risk goes way up, I allocate less because usually the potential is far greater in some of those. And I try to link up technical analysis with all of this to see what the fractals are in the charts. A fractal, so if I were to pull this up and I were to look at like Elliott wave. So a fractal, so the markets move, you got these Elliott waves, they move in these types of waves. And here's, Elliott wave theory right here. They kind of move in these little waves, and you get 1, 3, and a fifth wave. So 1, 2, 3, 4, 5. Then you get an ABC correction. The size of number 1, if you can identify it, is a fractal of the entire move here. So that's what I mean by the fractal. It's the size of some of these moves, and some of these moves are absolutely massive. And the fractals that I've seen in the commodities, like some of these companies are just gigantic. Like I've never seen fractals that big. And what that means is the potential could be massive coming up because of the fractals within the waves. Now, does that mean that I should put all my money in a high risk explorer because the fractal is really good? No, but I do think if a fractal is really good, that you could gain some exposure to it. If you allocate, and it's a strategy, guys. It's not trying to hit the lottery. It's not trying to predict which one it is. So let's say you've got 10 companies that exhibit these massive fractals, like massive ones. Like we're talking the first wave could be something that's usually like an entire move of something else. It's the first wave. So the way that I would look at it is you're not trying to win every single investment. I mean, you're trying to, but you might not win every single one. But if you've got 10 of them that exhibit this and you go across all 10, you only need a couple to hit. What I mean by like massively hit. So if you get like a 20 or 30 bagger or 50 bagger, if you get one or two of those in your portfolio, I mean, your portfolio is completely changed. It really puts the returns down. And sometimes if you have existing infrastructure in place, you have a potential cash cow from last market coming into this market, and they're just down because they have some debt and the commodities way down. Those are the ones I really like because your risk is a lot lower with those because they have the infrastructure in place. The other ones, they have to build the entire thing out, and sometimes they don't build it and they still do very well. But those are the ones that I prefer. So it's a strategy. It's how you allocate money, and the better, the more smart you allocate. I should say, the better the strategy and the smarter you allocate capital, really reduces your downside and increases your upside returns. Because you're going after companies that have a higher probability of returning very large returns. I know a lot of people, they look at the possibility of these small explorers and they want to put all their money in it. And maybe that works out if you spread across a whole bunch of different explorers. I just, the reason like oil and gas was so good to me is because they were all cash cows in the last bull market. What makes you think they couldn't be this bull market? The fractals of the first move were massive. And they had infrastructure already in place. So I piled into those. That's the ones that I piled into. And it worked out. It just happened to work out because oil came back, the infrastructure's in place, and now they're generating a lot of cash. Pretty good returns. And I think that will continue going forward. Now, the next one, shipping looks really good. And again, spread across a couple of different sectors. It's not all in one. And is like, what's enough money allocated to this? Well, I think it's all just a percentage. If you want to have 20 or 30% allocated to commodities, you can go even higher than that if you want. It's up to you. It's really up to you and what you feel comfortable doing. If you've got, dollar amount, if you have $100,000 exposure to it, yeah, that's great. That is great. You don't have to put everything in this. You can still be massively diversified. I allocate a lot of money to physical metals because I think that they will capture the gain and they're the least risky. So yeah, that's what I've got there, guys. I mean, I just wanted to go over this kind of short. I'm getting some questions on it. If you need help doing this stuff, if you want to see how I've set mine up, you can join the Finding Value website as a platinum member, and you can see all of the stuff that I have. Now, I didn't go into how much money I have allocated into each one because it shifts so greatly over the bull market. I allocated probably 20 or 30% to oil, and that thing's now over 50 or 60% of my portfolio just because it's gone up so much. And that was uranium, oil, and natural gas, and then I had other ones in there. But I have a feeling that that's going to turn around. I have a feeling that the precious metals that I'm accumulating, and I'll still accumulate this stuff, they'll catch up. They'll catch up towards the end of the bull market. And same with shipping. Shipping's a very small percent right now, and I'm continuing to allocate to things that are down. Energy service, shipping, and all these other sectors. If you want to see the companies, yeah, obviously check out the website, Platinum Membership. You can see all the companies I'm accumulating. I did release a video here shortly on Sunday before the week on the companies that are on my watch list. And remember, guys, we got to be having buyers step in here. If the buyers don't step in, I don't step in. I'm going to wait for this to settle down, but you can see the ones that I'm watching. All right, well, that's all I've got. Give me a thumb up for the content, subscribe to the channel, and we'll catch you next time. This is Finding Value.